Welcome everyone again for today's webinar on algorithmic trading by Backtestig. And topic for the day is stock data analysis, Excel versus Python. Now, this is a very interesting topic, especially given the fact that a lot of traders coming from trading background are not that good with programming, or they find programming difficult, Python, right? So how they can use Excel, and it's very important to understand that what are the limitations with Excel and what are the advantages with Python, or what are the advantages with Excel and limitations with Python and everything. So for today's session, we have Jay Parmar with us. So if I introduce you, Jay Parmar, he is associate in content and research team at Quantumsty, and he comes with several years of experience in the banking and financial service and insurance industry. And he's actively engaged in content development for quant finance courses and mentors EPAT participants across the globe. Now, he's passionate about algorithmic trading and programming and enjoys developing automated trading systems. Uh, Academically, he has a bachelor's degree in computer science, and most importantly, he is also EPAT certificate holder. So, yeah, and his research interests are in applying machine learning models to various facets of trading. So this is about Jay, and without taking a lot of time, I'll pass it on to Jay. So welcome, Jay, and the stage is yours.
Thank you, Shatish, for the introduction. Hello, everyone. So this is Jay here, and I will be the presenter for today's workshop. And I welcome you all from wherever part you are in, and I sincerely hope that you guys are taking adequate precautions in these unprecedented times. So today we would be discussing about two prominent tools that are used across the industry by the industry practitioners when it comes to analyzing stock data, which are Excel and Python, right? So I hope, again, before I start my presentation, I sincerely urge you guys to be as interactive as possible. You guys can send questions on your questions panel or whatever query that you have, and we will try our best to take those queries during the lecture or either in the Q&A section, right? So let's start. Now, when it comes to stock data analysis, there are several things that we can perform or we should perform as a quant researcher. And if I have to tell you the laundry list of operations that we can perform or we might perform or that we should perform are some of those, as you can see on the screen. Give me a minute. I believe so these are the different kind of analysis that one can perform. So amongst all kind of preliminary analysis that we can perform on a given stock data, like analyzing stock returns, or I would say analyzing the distribution of stock returns, that is how the returns of a given stock is distributed during among the historical period, or I would say how we can derive a stock beta as compared to its benchmark, or we can say how we can derive a stock beta with compared to the broad index for the particular geography. Next, we can perform analysis basically. So let's say if you want to create a portfolio, one of the very first analysis that you might want to perform is like how you can create or how you can determine which two stocks are correlated, right? So as this saying goes, like we should be very careful and we should be very apt while choosing the stocks when we have to create a portfolio, and that is we should choose stocks which are uncorrelated, right? and then we might want to come up with a strategy which captures the momentum in the market. Then in that case we might want to calculate our rate of change, right? And among all these kind of preliminary analysis, one thing that we should always perform or do before we can take a particular strategy live is to backtest a strategy. And this backtesting part will be the focus of this particular workshop today, where I will spend my most of the time explaining various facets of it and all such things. So before I go on creating a or backtesting a strategy, let's spend some time going through some I would say, some of the crucial or some of the preliminary analysis that we should perform on a given stock. So for that, I will jump right to the Excel, which is the very handy tool for any finance or the quant professional. So here I have stock data, particular of the stock data of AAPL company, ranging from 2005 to 2021, which is of almost of 15 years of data, and I have adjusted close prices of it along with the volume data. So as we had seen here, one of the tasks that we might want to perform is the understand the distribution of the stock returns. Correct. So how we can do so? So first we need to calculate the daily returns, and for that purpose I am calculating the percentage returns for the given stock, and I have a daily data here. So in case if you guys have intraday data, you can perform the analysis same way. So the first thing that we can perform is the calculate the returns per period. So here I am calculating the daily returns of all those 500 all those 4000 data points. Once I calculate the daily returns, all I can do is I can select the column and I can go to data analysis and create the histogram of it. So once I create the histogram, Excel will give me the frequency distribution, right? So the frequency distribution of how my data, how my daily returns are, say, distributed across the values, correct? So it will try to segregate those data in some kind of bins. So here I am not providing any number of bins here. So Excel is calculating those bins by itself, correct? And now once I get this frequency table, so if I scroll down this frequency table, and I would be able to see that, okay, as I am going towards the middle of this table, right, I can see the more and more frequency of these particular values, correct? So again, as always, numbers always look good on chart. So let's go ahead. Let's take a step further and see how it's appeals visually. So this is the returns distribution for AAPL from 2005 to 2021. And as we can see from this particular chart, that most of the time, right? So this longest or the this largest bar here we can see, right? So most of the time the returns remains between 0% to 1% on a daily basis, correct? So but that's not it, right? That's not all. So we can see that, okay, this particular return distribution also emerges something known as the normal distribution as well. However, with the pickedness of this particular returns is something more than the normal distribution. However, that's one point that I can infer from this particular analysis, that most of the time, almost I would say, so if I say like my value is 583, right? So I can see that after 4000 days, for 583 times, the return stays between 0 to 1%. And if I'm creating a strategy around it, I should be able to get this percent of times my result on my strategy on somewhere on these lines. So if yes, then I can infer that, okay, my strategy is performing according to what stocks according to the stock behavior, correct? But not only that, this particular returns distributions also shows me that the returns die on this tail as well and this tail as well, right? So if I zoom in this chart, like I can see that okay, for one or two instances, the results, the stock have also fallen down up to 12 or 11 to 12% in a given day as well. So this is also a bit of concern for me. Correct. Like okay, if I have a strategy which shows my return distribution something similar to this, then it's a cause of worry. Correct. So we can perform such kind of analysis after say creating backtest or after backtesting a strategy as well. But again, however, here the objective is to uh, analyze and see what are the distributions of the returns over the period. And similarly, on this tail as well, I can see that there are some data points which lies on the extremes. Correct. So in statistical terms, these are something known as the outliers or something that is beyond three standard deviations. So if we go to this histogram data or the frequency table, I can see that okay, for some of the periods, my returns lie greater than 10% on some occasions, right? So I should really deep dive and see what causes these extreme results. And similarly, on the other side as well, so I can see like okay, for some instance, this particular stock has fallen up to 18%, correct? And for some other instance, it has gone beyond negative 10% again. So this might be something we can tell again, is this a cause of, or I would say, or the result of black swan events, something that we need to deep dive and see the cause. So this is first thing. So this is how we can go ahead and create the histogram of returns distribution. And similarly, the way I present histogram here is for a given stock. Again, you guys can go ahead and create this such kind of histograms for your strategy results and make the insight, get the insights from it. Uh, the second the second illustration that I wanted to show you guys is how to determine the correlations or why correlations are important. Right. So let's say here my objective is, let's say I am involved in creating some kind of momentum strategy wherein I want to include this volume data. So let's say if my objective is like the trading hypothesis that I am working with, something says like this: I need to check whether the surge in volume has any effect on the stock returns or not, right? So let's say for an example, if for a given day the stock rises above 3% rise, and I can also see that okay, on that same day the volume is also greater. So is there any real relationship between the change in the volume and the surge in the returns? So what I can do here is I can create the change in volume, which I am doing with the help of percentage returns as well. Again, right, just to make the apple to apple comparisons. So here I would calculate change in volume for all the data points, and once I calculate those change in returns, I will try to compare it with the daily returns here. Correct. So what I do is I can go ahead and use this correl function which Excel provides me, uh, and I will provide my daily returns as one input and my change in volume as another input. So if I do so, it will tell me the correlation between uh, these two variables. Okay, so what do I mean by the correlation? Simple, like what is the effect in variable B based on the based on the moment in variable A. Correct. So here we can say that we can see that the correlation is almost null or almost nil, right? It's almost zero. So, or I can say it's slightly negative as well. And again, we won't be able to. So this, I would say, this correlation number tells me that okay, in reality, there exists no relationship between daily returns and the change in volume, right? So as compared to the previous day, if the volume is increasing, right, it really has no effect on the kind of returns that it is generating. So this is what I can infer from this correlation number. However, I can always go ahead and visualize things. Okay, so how do I visualize things? I can go ahead and plot this scatter chart of these two variables to see how these things are looking visually. So I go ahead and plot the scatter chart, and from the scatter chart, it is uh, eminent that okay, there exists no relationship between, or at least there is no linear relationship between change in volume and the stock returns. And as we can see here, this red line shows that there is a slightly negative relationship between these two variables, correct? Which is quite evident from this correlation number as well. But again, does that mean if there exists no linear relationship, will there these two variables are not related at all? Anyone? COE here describes change in volume. So volume is also adjusted volume. Yes, the volume is also adjusted volume. All right. So as we can see here, these two variables, what we are seeing here, they does not have any kind of linear relationship. But however, we can see that we can uh, again take a step further and see that there might exist a non-linear relationship as well. But that's the topic for some other day. However, as of now, from this particular analysis, we can see that there exists no linear relationship. Perfect. So these are the two different these are the two illustrations that I wanted to show you where Excel can be really helpful. So basically, it's like if I want to test out my some hypothesis, or I want to test some preliminary ideas, Excel is a way to go. Excel is a very handy tool and allows me to perform such kind of things in almost easy almost easy to use manner, right? Uh, now now that we know that we can perform such kind of analysis, and based on all these analysis, let's say we come up with an idea that we want to create a strategy that captures the momentum in the market, right? And to do so, what we need to do is like we need to backtest a strategy. So let's take a step further and try to backtest a strategy. So I have an interesting question here. You were showing correlation between price and the volume of the same stock. Yes, that's correct. It was the price and the volume of the same stock, and it was not the correlation between the two stocks. So this example, what you are seeing on the presentation right now, and what I had shown you, they both are the different examples. Excuse me. So now let's take a step further and see what are the steps that we need to go through to backtest a given strategy. Uh, so in order to backtest a strategy, we need to perform steps like so the very first step that we need to perform is first we need to have a stock data. Obviously, without any kind of data, we won't be able to perform the analysis, right? Then we would be computing the buy and hold returns, which we would calculate in terms of daily returns. Then we need to create rules. So what are these rules? So let's say if you are building a strategy based on some fundamental data, for example, if you are considering going long or going short based on P ratio, then in that case you would be calculating those P ratio, right? Or you should have that data ready with you in case of say if you want to create a model based on machine learning, then this create tools will basically encapsulate that part, that creating a machine learning model. Or say if you are from a technical background and you want to automate your technical analysis strategy based on technical indicators, those creating technical indicators will go in this third step, that is creating rules, right? Then once we have those rules ready, once you have the fundamental or the base based on which we can create the trading signals, we will go ahead and create the trading signals. And once we have those trading signals, what we can we will basically complete the last step, that is the computing the strategy returns. So to do so, what I will do is I will right jump into the Excel, which is, as I said, a very handy tool to uh, backtest a given hypothesis or given trading idea, right? So let's go ahead, and here I have a strategy that is based on the moving average crossover. So what this moving average crossover really does is it tries to capture momentum in the market. So for example, let's say I want to go long on a stock when it is trending upwards, and I want to go short when the particular stock is going downwards, right? So all I can really employ, or all I can really employ is a moving average, right? uh, this moving average basically tells me, okay, if the stock is going up, the moving average will go up, and as the moving average will go up, I simply need to buy. And on the other end, if the moving average is going down, I simply need to sell it. Correct. So let's go step by step. So the first step is to fetch the historical data. So here I have structured market generated open, high, low, close, and adjusted close and volume data, right? So this is my until this point I have my first step. So again, the backtesting period remains the same. That is from 2005 to 2020, which is approximately 15 years. Then I would go ahead and compute the second step, that is calculate the buy and hold returns. So I am again here employing percentage returns, which will allow me to calculate the geometric returns in the last step. Once I am done with the first two steps, I can go ahead and create rules. So again, as we discussed, we want to capture the momentum in the market. So what I will really do is, right, I will create those two rules based on which I will create my trading signals, right? So these two particular columns shows that particular rule. So all I'm doing is I am calculating the average of last 10 periods, right? Now while calculating these things, I need to make sure that there is no any kind of look ahead bias or survivorship bias, right? So on the rolling basis, I will calculate the 10-day moving average here, which I call it as SMA. And for LMA, which is my long moving average, I would be taking last 20 period prices, correct? So these SMA and LMA are basically shown by these parameters. However, as of now, these two parameters are static, and changing these two parameters won't have any changes on this SMA and LMA, right? So once I do so, I will be calculating SMA and LMA on last 15 years of data, which is my third step here, create rules. Now on the fourth step, I would create generate the trading signals. So my trading signal really goes this way. If the SMA is greater than LMA, I would simply go long, otherwise go short, right? So basically it will show me if the prices are rising, then I need to go long. If the prices are falling, I need to go short. And here in the signals column, uh, by one I mean go long, and minus one shows go short, correct? uh, all I really do here is like I employ a very simple if condition, and I check if this particular value is greater than this value, then I simply go long, else I simply go short, right? Once I have these trading signals in place, all I need to do is I need to calculate the strategy returns. And what I do is like I calculate my strategy returns that is multiplying my daily returns with my yesterday's signal. Correct. Once I do so, I would be able to calculate my strategy returns. So this is the fifth step that I am performing. Now, once I do so, I will go ahead and compute the strategy returns, which is nothing but the gross returns. So if I would have deployed this particular strategy, it would have returned me 555% in just 15 years. And if I deduct my invested capital, then it shows me that I would have earned almost or yielded 455%. In other words, uh, a $1 invested would become $5.55 in last 15 years. All right, perfect. Now, what do you guys think? Okay, so the strategy parameters that I have chosen here, right? Are these the best parameter, or I can do anything here to make the strategy more fruitful? Anyone? So someone asked, what is the long or short or how much quantity? So it's you can consider it uh, one share or one lot or whatever. So essentially, it's 1 unit. All right. So what I can do here is I can go ahead and someone asked how I arrived to these gross returns. So these gross returns are nothing but the geometric returns of the strategy returns that I had earned over these 15 years. Yeah. So it is simply nothing but the percentage returns plus one and the product of all those periods. So yeah, that's correct. So as one of our friend is telling us that we need to optimize these parameters, right? All right, so let's do that. So what I can do is I can go ahead and I can create a new sheet wherein I have the similar data here, but now this time I need to make a change in a way I calculate my SMA and LMA, right? So now in this time I need to make my formulas so that it becomes adaptive of this control panel here. So based on these parameters that I include here, it should calculate moving average for that particular periods. Correct. All right. So to do so, what I have done simply is I have simply used the row function and the offset function from the Excel to make it dynamic. Correct. So this essentially allows me to control these the calculation of moving averages, these two averages from these two numbers here. So if I say change it to 11 and if to 23, all I can see here is like this my returns are changing. Correct. So again, so yeah, so that is the first step, that in order to optimize our strategy, we need to first change our code such that it adapts to the dynamic version of the parameters. So once I implement those things, all I can do is I can go ahead and make use of a data table which is available under the what if analysis and data table here, right? This data table allows me to create a table something like this, right? So this table essentially shows me that okay, based on these two parameters, that is 10 and 20, right? If 10 if the combination of 10 and 20 is yielding me this particular result, that is 555%, right? What parameter should I choose so that it maximizes these returns? Correct. So all we can see is like this is my SMA value and this is my LMA value, and all it shows me is that if I choose either one as an SMA parameter and 25 as my LMA parameter, it will yield me 736% returns. So let's go ahead and check update those values. So I will update my SMA to 11 and I will update my LMA to be 25. And yes, I can see that once I choose these two parameters, right, I am getting the yield of 736%, which is far greater than 10 and 20 parameter, which was yielding me 555%, right? Perfect. So let me see if I have received anything here. How do you work out SMA and LMA? So as I said, I deploy offset and row function, and based on those things, I calculate the average. Where do you get all this data from? So I get this structured data from data vendor. In this, when we have taken a long, we have yes, that is so. As I discussed earlier, here we are considering only one quantity. So that is again, in case you want to go for 10 quantity, you can simply go ahead and calculate those returns with that particular leverage, right? What is the strategy returns? The strategy returns is here, right? So this is my gross returns and this is my net returns. Strategy returns is nothing but the calculations, that is the daily returns multiplied by the previous signal, right? So if I enter position on Monday, I would be able to calculate my result on Tuesday and thereafter, right? I cannot calculate my returns if I enter a position on Monday close. I cannot calculate returns on my Monday close itself. I need to start calculations from Tuesday. All right. So yeah, so this is good and fine. However, if we really see that, okay, if I go ahead and infer that, okay, this is the strategy that I want to work with, right? So now I would say that, okay, yeah, or okay, this is on this on one single stroke, right? Now, what if I want to replicate this same strategy on multiple strokes? In that case, uh, I need to download all those data and perform this kind of analysis in different sheets, right? However, one might say that that is not efficient. That is computationally and effort-wise as well. Correct. So, what is the other way around, right? How we can make this kind of analysis in much efficient way and in less efforts. So let's see that. So again, as we discussed, right, why we should use Excel, because it is being used across the industries, right? So all of your colleagues, all of your mentors with whom you're sharing your research, or say, so they all are highly likely that they are aware with this spreadsheet, and they all know how what you have done. uh, Excel also has a comparatively smoother learning curve. So if you want to perform such kind of analysis, it should not take much. And again, as we had seen here, right, it's a very handy tool to test our hypotheses. So again, based on the preliminary analysis that we had performed, uh, I wanted to check whether if I deploy something like moving average crossover, so it basically gave me the idea how my analysis would have performed. So again, I can see that my analysis might perform in a positive manner. So again, it made me it enabled me to perform this kind of analysis very easily. But what if I want to say include one more parameter here, or one more technical indicator, or say what uh, if I want to basically replicate this particular strategy on 5 different stocks, right, or on a universe of stock. So in that case, I need to perform all this kind of analysis again and again, which is not quite evident and which is not efficient as well. Correct. So uh, what is the workaround, right? Or what is the or what are the other courses that where Excel for sorts, right? So first, so let's before we go to the workaround, let's discuss what are the different things that we might face issue with Excel, right? So Excel cannot really handle large data. So let's say here I have a daily data for past 15 years. But what if I have, say, 1 minute data for past 15 years, right? That would be almost like 1.5 million rows, right? So in that case, the Excel would reach its limitations, right? So in such scenarios, the Excel might not be the correct tool. The second thing is like Excel is not meant to uh, say handle the unstructured data. What do I mean by the unstructured data? All the data which does not come in tabular format, like news data or the sentiment data, or the or I would say tweet data, right? Based on which I can perform a sentiment analysis. Uh, the second thing is that as the size of the data increases, it keeps getting slower and slower, right? So again, for a quant researcher, it might be one of the it might be one of the issues, or it might be one of the pains which we not want to trap in. Second, as we discussed, right, if I want to backtest given strategy on multiple stocks, I need to perform all these operations again and again. Yes, of course, we can deploy macros and all such things, but again, there it would involve some kind of middle work again as well. One of the main things that I am cognizant about is like if I want to say if I have, yeah, if I have a third parameter and I want to optimize all those three parameters, uh, I need to basically choose a combination of two pairs. Then I need to choose third pair. So essentially, I need to perform such kind of data table activities again and again as the number of variables increases here, which is quite not efficient. Correct? And again, Excel is not really a tool to deploy or say implement some really advanced techniques like machine learning or a time series analysis and all such things, right? So what we can really do is, right, we can resort to something known as programming language, and we should leverage the power of technology or the power of programming and do all such things. So what I will do is I will be going ahead and I will demonstrate these similar things in Python, and we'll see why backtesting such things, or when the scalability or the flexibility is the objective, why programming really helps us, right? So what I will do here is I will basically try to mimic what we had done here in Excel, and I will try to replicate this same strategy, and let's see how easy it is to basically do such computations with the help of a programming language, right? So, so the first thing that I will do here is like I will first import the necessary Python packages, which allows me to perform all this kind of analysis. Then I will simply read the data that I would require to basically perform all the computations on. So basically, this is my first step, right? So fetch the stock data. So this was my first step. The second step is really the second step really is the calculating the buy and hold returns, right? So again, as I said, like we would be calculating the percentage returns, and then we would be creating all the rules, right? So again, it tells me that SMA is not defined. So let me go ahead and define the strategy parameters, right? Now, once I have all the rules in place, I will go ahead and create the trading signals. That is the fourth step. And just to make sure that my calculations are not being hampered with any null values, I would be simply getting rid of it, right? So here I am placing dropping all the null values, and simply I would go ahead and calculate the strategy signals. So first we fetched the stock data, then we calculated the returns, that is the buy and hold returns. Then we created the rules. Then we created the trading signals, generated the trading signals here, which is here. And lastly, I would simply go ahead and calculate my strategy returns. Once I calculate the strategy returns, I would calculate the cumulative returns, like all the returns that have been generated or during the backtesting period, right? So let me go ahead and print it, right? So I can see that these parameter 10 and 20 parameters generated the returns of 455%, which is quite evident from this particular strategy, right? So my net returns are 455%, which is same here in Python as well. All right. So if you learn by the example, or I would say from the visualization, let's try to visualize the returns. So this is how our strategy would have done during those last 15 years. Quite good, right? I do not see much of the drawdown here as well. Perfect. And now let's take a step further and see the how the signals would be. So whenever it is +1 here, it shows me that I would have been long all this time, and whenever it's -1, it shows me that I would have gone short all this time in past 15 years. All right, let's try to combine these two plots, and this is how it would look. So for so the green chart here shows me that I have been long all this time, and here it shows me that I have been short all this time. And during all those periods, this is how my strategy would have performed. All good and fine. Now, this is something that we had also done in Excel as well, right? So, what's the use of using programming over Excel, and how does it help me, right? So, one of the two issues that we were facing is like or I would say they were not exactly the issues, but the inefficient way of doing analysis was that if I want to replicate this particular strategy on multiple stocks, right, I need to create those five, all those five steps again and again, and basically create and calculate all those things manually here, right? Now, when it comes to programming, all I can do is that I can use this same code, right? I can use this same 10 lines of code and apply these 10 lines of code on various stocks, no matter how many stocks, and get the results. So what I can do here is, right, uh, now I will be basically backtesting this particular strategy on five different stocks here, right? And I would keep these parameters same, right? So here I am defining my stock universe and my strategy parameters. Now all I do is I will create a function of these 10 lines which I had created here, and basically put all those 10 lines, 10 lines in a simple function, correct? That is backtest strategy. And once I put all those 10 lines in this particular function, I will go ahead and run this strategy or call this particular function on all five of these on all of these five stocks, right? With the help of a for loop. So let me go ahead and see, right? So see how fast is it is to basically backtest a particular strategy on multiple number of stocks. Now imagine like you have to perform all these analysis manually or on a given Excel, right? It would have created a lot of files, and again it obviously it would have been time consuming, correct? So let's go ahead and see the results. So I can see that okay, for Facebook the results over past, I would say the past 7 years, right? The results for past 7 years for Facebook was negative, right? For Apple it was positive, and so on. So let me go ahead and print those results. Yeah, here it is, correct. So I can see that okay, if I have went ahead and implemented the same strategy on these five stocks, correct? If I implemented these five strategies, my results should have been something like this for the past 8 years, because now the duration is from 2013 to 2020, correct? Excuse me. So here I can see that okay, apart from this APL and Amazon, all the three stocks, the remaining three stocks would have yielded into the negative. So can I do anything? Yes. What I need to really do is I can go ahead and optimize this parameter, right? So from this generalized model that I can see that okay, while two of those five stocks are performing well, the rest of the three are not performing so good. So all I can do is right, I can go ahead and optimize these parameters. So what I can really do is like if I optimize this parameter, and I would see uh, how it would end, right? So again, as I said, right, all I can do is I can simply reuse this code. Correct. What I will do is I will simply reuse this code and see, okay, what parameter of SM and LMA is giving me the best result, right? So let's go ahead and see. So what I'm doing here is like I am creating a series of LMA values, SMA values, that is something like this: 6, 8, 10, 12, and all such values. Similarly, for LMA, I am calculating a value of 20, 22, 24, and so on. Right. Uh, this particular this particular function will apply brute force algorithm on all the combinations of these values, all the combinations and the pairs, right? And then it will give me what are the results, correct? And once I do so, I will apply this particular function on all the stocks that I have here, right? So let me go ahead and perform this kind of these computations. All right. So as I can see here, right, uh, this piece of code, this particular piece of code, right, it actually checked all these parameters: SMA 6 and 20, 622, 624, right? Like I would say there are almost 50 pairs for a particular stock, right? So in total, it checked for almost 250 combinations across these five stocks. It had computer basically backtested my strategy. Now this is some seriously good computations. This is some seriously good leverage of programming, right? So let me go ahead and see the best SML values, right? So what it tells me, right? If I had chosen the SMA is 18 and LMA is 20 for Facebook, it would have given me the best result. For AAPL, it would be 10 and 22. For Amazon, it would be 10 and 24, right? So let me go ahead and see what are the results. So what I do here, I will simply go ahead and see. Perfect, right? So now I have been able to basically generate the results that are actually giving me the results in my backtesting period. So initially, when I applied the raw version of the strategy, I was getting three stocks in a negative and two stocks were performing well. But now that I have optimized all those parameters, it has given me a quite good results. Right. All right, guys. So, yep. So, so this is how we can basically go ahead and leverage the uh, programming language and make a good use of it, right? uh, so just to summarize uh, so just to summarize we can use Excel when we have some kind of preliminary analysis, or when we want to basically check our hypothesis. In such terms, the Excel really comes handy, right? And when the objective is to scale your operations, and when the objective is to basically move towards the advanced side of the trading, right? We should choose a tool that allows us to perform all such kind of analysis more efficiently, right? All right, guys. So now I will open the room for Q&A, right? Hello, Sitish, you there?
Yeah,
All
thanks a
right.
lot, Jeff. That's a wonderful presentation. I think so many new things I've learned today, and I hope a lot of our uh, attendees today learned a few things as well. So amazingly, I mean, it's great to see how one can work on a simple hypothesis just by starting off with Excel, and then in order to scale it up to another level where you can have multiple stocks and you backtest them. So then that is really amazing. So thanks a lot, and I think we are getting tons of questions, and considering a lot of questions coming up and common questions that I've seen people asking whether this session will be recorded or not. Yes, this session will be recorded and will be shared with all the webinar attendees and registrants over email. It will be uploaded on our YouTube channel and on our blog as well. So all of you will have access to this recorded session. Feel free to share it across your circle, friends, and whoever you think can benefit from this content. So we love to produce such content, and I think this will help a lot of users or a lot of people who really want to get into the quant side of trading. So lovely presentation. Thanks, Jay. So we can start off with picking questions. I'm seeing a lot of questions, and I we will definitely try our best to answer all the questions that are there. In case some of your questions are not answered, you can always email us at contact@quantinsti.com, and or any of our social media handle. You can just reach out over there, or we also have a community where you can go and ask any of the questions, or you just comment on the webinar recording. That's also fine. So we'll try to address all of your queries over there as well. So interestingly, now uh, how we are going to do is, Jay will also go through some of the questions which he finds are relevant, and we can answer straight away. We'll pick those, and I'll also see some of the questions one by one. All right. So let me just go through. So first question, okay, that I'm seeing, a very recent one is by Mohan Kumar. He is asking from where we can get this data. Now, before going to Jay, I think we already have a blog dedicated to where you can get market data. So there are different sources. You can also get this data for free through some of the sources with some limitations. And if you really want the market data for minute level, I think you can purchase some subscriptions for different platforms so that are available. So you can go through that blog. I think it covers a lot in detail. So blog.quantinsti.com, there you'll get all the details that you want. All right. Another one is, can we use Python for options trading? And this one
Uh,
is asked by English Burma.
yes, so we can very well use options for Python or options trading as well. So in fact, people are using Python to trade options very actively. And if we see the economy, if we see the ecosystem as a whole, right? So nowadays, most of the modern brokers are supporting or providing support and APIs for Python, which can easily be used, and we can leverage those APIs and trade any kind of assets using Python. So yes, very well, we can use Python for options trading.
Wonderful. I hope that answers your question, Jayesh. Another one that we have got from Avinash, he asks, with the back strategy results, I mean backtesting strategy results, what do
Mhm.
we do next? Can you deploy it on Apple stock?
So it really depends on the geography that you belong to. So if someone wants to say, so there are multiple things that we can do. So once we have backtest result ready, right? We can always go ahead and try to create the deployment algorithm for it, and we can deploy those things. But now, whether we can or a person can trade Apple or not, it really depends on the geography that he or she resides in, right? So yeah, but again, if one has an access to the market where Apple is being traded, of course you can go ahead and trade those things.
Certainly. And what if, if you, so it doesn't matter whether it's Apple or any other stock. So the
Absolutely.
geography that you belong to, you can pick any of the stocks that you want. And I think based on the broker support that you have, you can go about it. So a related question that we have is, can we integrate Python to our broker?
It depends on the broker as well. So, but again, as I said, right now, in today's time, most of the broker provides uh, some kind of API, be it Python API or REST-based API. If at all broker is providing any kind of API, certainly there is high probability that we can always go ahead and use Python to connect with a broker. But again, at large, it depends on the broker as well, whether the broker is providing an API or not.
Hmm. And I think nowadays a lot of broker have moved, made
Yes,
efforts,
that's correct.
and they
So,
are
so as I said, that's correct. So, as I said, like if we see the current scenario, not only in developing markets, but in general, most of the modern day brokers are providing their Python APIs, right? Which really integrates well with any kind of charting, or even a raw Python can be used easily. Correct. And looking at those market trends, even traditional brokers have also started giving their Python APIs, access via APIs.
Yes, wonderful. So now, considering like this session was more from the, giving a fundamental knowledge about difference between Excel and Python and
Mm-hmm.
various advanced both of the platforms. So another questions from a trader. So Arun asks, if is this analysis possible for someone who is not from a hardcore quant or programming background? He's a trader.
Yes, yes, very much. Yes, yes, very much. So I tell you, if I have to give in my example, right? I am not from the quantitative background, or if I am not from the finance background, right? All I had done was like I had spent quite the time and efforts on basically learning, or I would say understanding how the market works, right? And what I had shown here is basically a part of those outcome. Correct. Yeah, it's so again, if I have to share my experience, when I started doing ipet, I was not knowing Python even. Correct. So after enrolling into ipet, I learned not only statistics and the quant perspective, but I also learned Python and was able to implement all those concepts using Python basically, and this is what I had shown here.
Yeah, that's a wonderful story. I think he's so Jay is the best person to answer that question. That's
Yeah.
amazing to know. So another question pertaining to quantity specifically that I've got from Ashish Shah is, how can quantity help us learn the Python language? So Jay, I'll try to answer this one.
Yeah,
So
sure.
see, Python is a fundamental language here that we teach, right? And it's the most if you consider different programming languages you have to choose from, so I think Python is the easiest one. And so in order to start off with Python, I think we have different courses, but uh, there are also many of the free content available. So if you go to our blogs, there are blogs on Python for trading. We have an ebook that is for free. We have a free course on Contra that is Python for trading basics. It's a free course. And then we also have a paid course that talks a bit about some of the advanced stuff that you want to look at. And then the rest of the courses that we have on Contra are all based on Python. Now once you have basics of Python, you can apply advanced topics or advanced concepts like machine learning, everything, all of that is also available, that we have developed in collaboration with leading exchanges and experts in the industry. On the EPAT side, I think we so when you enroll in EPAT, that's the most comprehensive program we have, our flagship offering. So there, I think there are tons of primers available for someone who is starting off fresh, for the don't have any programming background. So there is tons of content available, both free and premium, that you can explore from. So yeah, I think you would love that. uh, Moving to the next question is uh, I think we are running out of time, so we'll just try to pick a few and then try to answer those. Do you use modeling stock returns distribution and its volatility for options pricing?
Yes, very much. So when it comes to options trading, looking at the distributions of not only the volatility, but again all the breaks that it has, right, it becomes quite inevitable. So in order to trade options successfully, one need to know how they are being priced, and how what are the ways that they can change during the course of their expiry, right? So when it comes to some complex derivatives like options, it becomes really important that we should be aware of each and every facet of it. Correct. And specifically, not only volatility, we should also be knowing about the Greeks, or the first Greeks that are mainly responsible for changing those options pricing. So to simply put, yes, very much. we should be using such kind of analysis, and we should see the distributions and try to infer like, okay, if the particular grade changes by a certain standard deviation, what will be the effect, and it would eventually help you out to say make better decisions.
Wonderful. Um, I think I'm getting a lot of queries regarding different courses that you can learn and fees of different programs. So I think you can just drop those questions. Our team will connect with you people individually who are interested in knowing about our courses. But meanwhile, we'll keep this section educational. So the next question, the second last question is. Can Python detect multi-bagger well in advance?
uh, So it depends on the kind of analysis that you are performing. So let's say if you are using some kind of this some kind of state of the art analysis using some advanced machine learning techniques like segmentations or the clustering, right? Using unsupervised machine learning algorithms. Uh, it can, but again, it depends on the kind of historical data that you feed in to those algorithms, and based on based on the historical data that you are feeding, from which you are tailoring your algorithm to detect multi-bagger or any kind of stocks, it might. So basically, the thing is like, first you need to think logically. What are the baselines based on which whether the stock is gonna multi-bagger or not, right? So again, machine is as good as our understanding goes. Correct?
Perfect. So I think we are going to pick the last question now. So that is, what are the packages and libraries of Python used for trading? Now, this is a very good question, and the best one I think that will help a lot of people who are just starting off with Python. So Jay, over
Yeah.
to you for that.
So there are quite a handful of libraries that we can use to perform. So basically, there are two aspects. So the first aspect is backtesting or the analysis part, which should be the first step. And then based on those things, we should go towards the live trading part. So now on the data analysis and the stock analysis part, there are quite a handful of libraries that are available on Python side. So the very first library is the NumPy, which is used for number crunching. Based on NumPy is a pandas library, which is used extensively for all kind of data analysis. And if you see here, I have used those two libraries to basically make all kind of my analysis, which is loaded at the very top. Then there is matplotlib, which is the de facto library for making all kinds of visualization. Now when it comes to some advanced techniques like time series analysis, we uh, we use states model and FB Prophet. Apart from those, when it comes to backtesting, we use PyFolio and Zipline. Then when it comes to machine learning and deep neural networks, we use Scala and Keras. And now on the other side, that is on the execution side, it really depends on what kind of broker that you are choosing. So most of the brokers would have a Python library on their own. If not, and if they are providing some kind of REST API, then we can certainly use request library to perform all kind of request and connections. And again, if I would say you and again on the third side, when it comes to implementation part, if you require access from one of the exchange authorized vendors, then those data vendors would provide you different libraries that you can use to access all those data in the real time.
Wonderful. And in fact, I also shared a link to our blog. So this blog has all the relevant libraries from basic ones to advanced ones that you can use for the, specifically developed for the trading purposes. So feel free to explore that blog. I think that will be helpful. So I think that's about it. I think we have covered most of the important questions, and I see there are tons of questions coming up, but we are short of time. So I would request everyone to just email your questions at contact@quantinstitute.com. With that said, I think I would again like to thanks Jay. Uh, Thanks a lot, Jay, for this wonderful presentation, and I think this was really amazing session. So many new things that we have learned today, and to all the participants who have turned up and uh, are supporting us in the this space, and really thankful to everyone, and I hope you all of you have a good day ahead, and please do take care and have a great day. Thank you, everyone.